Okay, so you're probably wondering, why are we here at Aldi's for this episode of Tipsy Tuesday? And one of the reasons is because your debt to income ratio is a huge impact on what debt you have in your life. And so before purchasing a home, one of the items that you want to focus on is eliminating debt. That's what the Murrell family is doing here in 2020. We are focusing on eating out less, cooking more, and shopping at Aldi's. Okay, so if you're like me and you forget your quarter about 99% of the time, what you can do is you can just go in and find a box of your own. I usually undo everything in the box and find my own. Okay, so my go-to for the whole week, gets me through the whole thing, is chicken salad. So this salad right here is $1.99. I can eat it twice, so it's 2 lunches. And then I'll grab another one. This one's $1.69, and we're gonna add chicken, and there's my week's lunch. Sometimes at Aldi's, they don't have everything that you're looking for. Usually the chicken we get's right here, it's $3.79. It already has seasonings on it and everything. So we're just gonna grab this one. It's organic. The ones that we usually buy are organic as well. So usually this whole calculation lunch will be about $2 cheaper, but you'll see that it's still huge savings. So what is your DTI? Your debt to income ratio is the percentage of your gross monthly income that goes towards debt payments. And debt payments can include credit card debt, auto loans, and insurance premiums, and also student loans. Mortgage lenders will calculate your DTI to figure out what loan program you qualify for. Different loan programs allow different amounts of debt in regards to the level of income. So in other words, there are certain debt to income percentages that you have to stay below in order to qualify for a home. So let's calculate your DTI. So in order to first do that, we have to know your gross total income. And so you can take out a piece of paper with me and do this. So let's say you have a salary of $45,000. You divide that salary by 12 months in a year, which means you make $3,750 a month for your gross income. That's called your gross monthly income. Now let's take a look at your total debts. Now, when I say debts, I'm talking about debts that report to your credit bureau. And so those debts are your student loans, car payments, and credit cards. We're not talking about a phone bill or anything like that. Only items that report to the credit bureau. So let's say you have a student loan payment for $250. Now let's write that down. Okay, you have a car payment for $250. And let's say you only have one credit card. Maybe the balance is around $4,000. But what is important here is the minimum payment. That's the only thing that the lender is going to utilize. And so that monthly minimum payment is going to be $25. So in other words, your total debt that reports to the credit bureau as far as your monthly debt is $525 total. Now, let's say the total house payment with principal and interest and taxes and insurance is $1,250 a month. That would mean your total debt, including the debt that currently reports to the credit bureau and the future mortgage payment for the house, would be $1,775. Now, divide this total amount by your gross monthly income of $3,750. That would mean your debt to income ratio is 47%. That would be your DTI. Now, like I said, every loan program allows a different debt to income ratio percentage. This video could go on and on. So if you have questions about calculating this or any other specific questions to this scenario, please give me a call. I have a background in mortgages. I would be happy to walk you through this, or I can definitely get you in contact with one of my preferred mortgage professionals today. I hope you've loved this Tipsy Tuesday. Sorry there's no drinking involved. Like I said, the Murrell family is focused on paying off some debt and eating out less, and that includes drinking. So until next time, have a wonderful day, guys. Bye.